I've been asked quite a few times lately about prepaying your mortgage, sending extra money in on top of your minimum payment. But that may actually be a big mistake. So in today's video training, what I want to do is break down for you the different variables and things that you need to look at if you're considering paying extra money onto your mortgage. Hi, it's Robert Weinberg, and on this channel we empower people to take control of their future through expert mortgage and financial strategies. In today's lesson, we're going to talk about a common question, which is, should I send extra money into my mortgage? There's a couple things you want to consider, but first let's talk about why you would want to look at this. So when you're sending extra money into your mortgage, typically that's going to go directly onto the principal balance of your loan. It's not going to go to interest. So that's going to lower the amount of time that it's going to take you to pay that mortgage back. And what that's going to do in turn is lower your effective interest and the amount of interest that you're going to pay over the term of the loan. When you sign your loan documents to take a mortgage out, it's going to be based on a contractual term, 10 years, 20 years, 30 years, etc. But if you send $1 extra over that minimum payment, you're going to manipulate that interest rate and that effective interest you pay over the life of the loan into your favor, and you're going to reduce the amount of time. So that's why it's an attractive option for some people to pay extra money. But we have to consider some important factors. So the first question is, do you have other debt? So do you have auto loans? Do you have student loans, credit card debt, medical bills, that sort of thing? If the answer is yes, then what are the interest rates on that debt? If the interest rate on that debt is higher than your mortgage interest rate, then you should not send extra money into your mortgage. You should be sending extra money in to those higher interest debts. So that is an easy thing to ask yourself to see whether it makes sense or not. Next question is, are you fully funding your retirement accounts, 401ks, IRAs, and whatnot? If you're not fully funding your retirement accounts, then you should probably not be paying extra on your mortgage. And the reason is that historically, retirement accounts would give you a return of 6 or 7% a year. Okay? If your mortgage is at 3.5% or 4% or less, then why would you pay extra on your mortgage when you could be earning 6 to 7% or more in a retirement account? That doesn't even factor in that you may get a match from your employer and that the markets could actually even do better. So if you're not fully funding your retirement account, then you should probably not be prepaying your mortgage, and you should be sending extra money in to your retirement account instead. Next factor you want to consider is, do you have a taxable investment account, like a brokerage account or another type of investment account that's taxable, where you could make a higher return than your mortgage rate? Like we just talked about in these other factors, if the rate you can get back on these other investments is higher than your mortgage rate, you should not prepay your mortgage. You should prepay those investment accounts. Put those extra dollars into your investment and other vehicles rather than concentrating on paying that mortgage down. It just doesn't make financial sense. Last but not least, do you have an emergency fund with 3 to 6 months or more of expenses? The reason that this one's so important, especially lately due to the COVID-19 pandemic, is that what if you lost your job tomorrow? Do you have the ability to pay your expenses for at least 3 to 6 months? Because here's the thing, when you pay an extra $100, $500, $1,000, or any amount onto your mortgage, a mortgage is a closed-end vehicle, which means you can put money in, but you can't take it out. So if you sent an extra $1,000 in to your mortgage company and then the next week you got laid off from your job, you would not be able to get that $1,000 back. That's why having the emergency fund with at least 3 to 6 months of expenses is absolutely important and crucial if you want to look at prepaying your mortgage. So if any of these factors are not already in play, then you should not prepay your mortgage. You should focus on these 4 factors that we discussed here. If you do have no other debt besides your mortgage, or no other debt that's at a higher rate than your mortgage, if you are fully funding your retirement vehicles, if you are putting money in taxable investment accounts already, and you already have an emergency fund with 3 to 6 months of expenses, then I would recommend that you prepay your mortgage, because you're already doing all the other things that we discussed that make more financial sense than sending extra money into your mortgage. So then that brings the question of, does it make more sense to refinance to like a 15-year mortgage or a 20-year mortgage, or just keep your mortgage the way it is and send in an extra 100, 150, 200, 500, 1,000 or more a month? So the real question or answer for that question is going to be, how often are you sending it? So if you're somebody that just sends in extra money when you have it available, 100 here, 50 there, a couple hundred later, whatever it may be, then you should not refinance. You should just send in the money as you're able to. But if you're paying extra every single month, so if you're paying like an extra $300, $400, $500 a month or more, and you're doing that religiously, then it's absolutely worth getting with a mortgage advisor and having them run numbers on actually reducing the term of your loan. Because you may see circumstances, which I see every day with my clients, where you're paying an extra couple hundred a month and you could refinance to a lower interest rate and a shorter term and spend the exact same money you're spending right now by paying extra and actually reduce the term of your loan down to, like we said, a 10, 15 year, 20 year type of term. So if that's the case and you're doing it every single month religiously, then it does make sense to explore some refinancing options with a mortgage advisor. I really hope this has been of help to you. I hope you've gotten value from today's lesson here. If it's your first time watching, please go ahead, hit subscribe. Also click the bell so you get notified on all of our future content. And if I can be of assistance to you or anyone that you know with refinancing a mortgage or purchasing a home, feel free to reach out to me via call, text, or private message.